If you think a $100,000 salary is enough to buy a home in 2026, you're about to get a very painful wake-up call. The rules of homeownership have completely changed, and most people are still playing by the old ones. And that mistake is costing them everything. Stay with me, because by the end of this video, you'll know exactly where you stand and what to do about it. Let's start with a question. What does buying a home mean to you? For most people, it's the ultimate goal: stability, freedom, something to call your own. It's the milestone your parents told you to chase. It's the thing society says you must do to be considered truly successful. And for decades, that dream was actually achievable. Work hard, save a little, get a mortgage, done. But something cracked. Then it broke. And in 2026, that dream looks almost nothing like it used to. Here's a number that will stop you cold. The median home price in the United States right now is hovering around $500,000. Not in Manhattan, not in Beverly Hills. We're talking about the median, meaning half of all homes for sale cost more than that. Let that sink in for a second. Now let's go back. Just 10 years ago, in 2016, the median home price in America was around $232,000. That means home prices have more than doubled in a single decade. Your income? It did not double. Savings rates? Did not double. Opportunities for the average worker? Definitely did not double. So what actually happened? Why did we get here? And more importantly, who can still afford to play this game in 2026? That's exactly what this video is going to break down. No sugarcoating. No fake motivation. Just raw, honest numbers. Because you deserve to know the truth about where the housing market actually stands and what it demands from you personally. We're going to walk through the real salary requirements, the hidden costs most buyers never see coming, what the banks look at versus what they don't tell you, and the brutal math behind monthly payments that are quietly destroying people's financial lives right now. All right, so now that you understand how we got here, let's get into the numbers. Because this is where most people completely check out. They don't want to see the math. They don't want to face the reality. And that's exactly why they stay stuck, confused, and financially unprepared when it's time to actually make a move. So let's do the math together, right now, and I promise you, by the end of this section, everything will become crystal clear. Let's use a $500,000 home as our baseline. That's the median. That's the benchmark. That's what we're working with. First things first, the down payment. The traditional advice is 20% down to avoid private mortgage insurance, which lenders call PMI. 20% of $500,000 is $100,000. $100,000. Cash. Upfront. Before you even touch a mortgage application. Now I already hear some of you saying, but I can put down just 3% or 5%. And yes, technically you can. But here's what they don't tell you loudly enough. If you put down less than 20%, you get hit with PMI, which typically adds $150 to $300 every single month to your payment. And that's money that builds you zero equity. It's just gone. So let's say you somehow have that $100,000 saved. Congratulations. Seriously, that alone puts you ahead of the majority of Americans. But you're not done yet. Not even close. You still need closing costs. And this is the number that blindsides almost every first-time buyer. Closing costs typically run between 2% to 5% of the home's purchase price. On a $500,000 home, that's another $10,000 to $25,000 due at signing, on top of your down payment. So before you've made a single mortgage payment, you're already looking at $110,000 to $125,000 out-of-pocket minimum. And we haven't even talked about what your monthly payment looks like yet, which is where things get truly brutal. With a $400,000 loan, that's after your $100,000 down payment. At today's interest rates sitting around 6.5% to 7%, your principal and interest payment alone comes out to roughly $2,500 to $2,700 per month, every single month, for 30 years. So we said your mortgage payment is roughly $2,500 to $2,700 per month. But here's what the bank statement doesn't show you. That is not your real monthly cost of owning that home. Not even close. Because on top of your mortgage, you have property taxes. In most U.S. states, property taxes run between 1% to 1.5% of the home's value annually. On a $500,000 home, that's $5,000 to $7,500 per year, which breaks down to another $415 to $625 every single month. Then comes homeowners insurance. Non-negotiable. Your lender will require it. Average cost in 2026? Around $150 to $200 per month for a home in this price range. Now add maintenance and repairs. The standard rule in real estate is to budget 1% of your home's value per year for upkeep. On a $500,000 home, that's $5,000 a year, or about $415 per month, for things like a broken heater, roof repairs, plumbing issues, and appliance replacements. Let's add all of this up right now. Bank mortgage payment, $2,600 per month. Classical building property taxes, $500 per month. Shield homeowners insurance, $175 per month. Wrench maintenance budget, $415 per month. Total, roughly $3,700 per month. And we haven't even added utilities, HOA fees if applicable, or any personal savings goals. The real number for many buyers quietly crosses $4,000 per month once everything is factored in. This is the number banks don't highlight. This is the number real estate agents gloss over. And this is the number that is financially suffocating thousands of homeowners across America right now in 2026. So now the real question, the one this entire video is built around. What salary do you actually need to comfortably afford this home? And for that, we use the rule that every serious financial advisor will tell you, the 28% rule. This rule states that your monthly housing costs should never exceed 28% of your gross monthly income. This is the golden standard. Banks use it. Financial planners swear by it. And it exists for a very good reason. So let's work backwards with our number. We established that the true monthly cost of owning a $500,000 home is roughly $3,700 per month. Using the 28% rule, here's the math. $3,700 divided by 0.28 equals $13,215 per month gross income required. Now multiply that by 12 to get the annual salary. $13,215 times 12 equals $158,500 per year. Let that number breathe for a second. $158,500 per year. That is the salary you need to comfortably, not lavishly, not extravagantly, just comfortably afford a median-priced $500,000 home in 2026. Now here's where it gets painful. The median household income in America right now sits around $74,000 per year. That means the typical American household earns less than half of what is needed to comfortably buy a median-priced home. This isn't a small gap. This isn't something you close by skipping coffee or cutting subscriptions. This is a structural, systemic disconnect between what homes cost and what people actually earn, and it is getting worse every single year. And if you're a single-income household, the math becomes almost impossible without significant external help or an unusually high-paying career. Now here's where things get even more interesting and, honestly, more dangerous. Because there's a massive difference between what you should spend on a home and what the bank is actually willing to lend you. Banks don't use just the 28% rule. They use something called the DTI ratio, debt-to-income ratio. And they typically allow your total monthly debt payments. That includes your mortgage, car loans, student loans, credit cards, to go up to 43% of your gross monthly income. So if you're earning $100,000 a year, that's $8,333 per month gross. The bank may approve you for a mortgage where your total debts hit $3,583 per month. And on paper, that sounds like they're doing you a favor. But they're not. Because the bank's job is not to protect your financial future. The bank's job is to sell you a loan. They get paid when you borrow. They are not sitting across that desk thinking about your grocery bills, your car insurance, your kids' school expenses, or your retirement contributions. That is simply not their concern. So what happens? People walk into a bank, get approved for a $480,000 mortgage, and think, great, I can afford this. But approved does not mean affordable. These are two completely different things that the financial industry has spent decades quietly blurring together. Getting approved for a loan you can technically make payments on is not the same as that loan fitting comfortably into your actual life. And millions of homeowners in 2026 are learning that lesson the hard way. Stretched thin every single month, one unexpected expense away from real financial crisis. This is the trap. And most people walk into it with a smile on their face and a set of new house keys in their hand. Let's talk about something that has quietly become one of the most devastating forces in the 2026 housing market, and that is interest rates. Because this single variable has the power to completely transform what you can and cannot afford, and most buyers dramatically underestimate its impact. Cast your mind back to 2020 and 2021. Interest rates were sitting at historic lows. We're talking 2.5% to 3% on a 30-year fixed mortgage. And at those rates, buying felt almost reasonable. A $400,000 loan at 3% meant a monthly principal and interest payment of around $1,686. Now fast forward to 2026. That same $400,000 loan at 7% gives you a monthly payment of $2,661. That is $975 more every single month for the exact same house, the exact same loan amount, just a different interest rate. Over 30 years, that difference adds up to over $350,000 in additional interest payments, more than the price of an entirely separate home. And here's the part that makes this even more frustrating. During those low-rate years, home prices exploded because everyone rushed in to buy. So now in 2026, you're not just dealing with high interest rates. You're dealing with high interest rates on top of inflated home prices. It's a double hit that has completely shattered affordability for millions of people. Some buyers are holding out hoping rates will drop back down. But most economists are not forecasting a return to those 3% rates anytime soon. The era of ultra-cheap borrowing is very likely gone, and the housing market has not fully adjusted to that reality yet. This is not doom and gloom. This is just the truth, and you need to understand it clearly before making the biggest financial decision of your life. So if the math is this brutal, if you need $158,000 a year, $100,000 saved for a down payment, and the stomach to handle a $3,700 monthly payment, then who exactly is still buying homes in 2026? Because people are still buying. The market hasn't stopped. Homes are still selling. So who are these people? First group, existing homeowners. This is the biggest and most important group driving purchases right now. These are people who bought homes years ago when prices were lower and rates were cheaper. They've built up massive equity, sometimes $200,000 to $400,000 worth. They sell their current home, pocket that equity, and use it to fund their next purchase. They're not starting from zero like first-time buyers. They're rolling wealth forward, and that gives them an enormous advantage that newcomers simply cannot compete with. Second group, dual-income high earners. Two professionals, both earning strong salaries. Think 2 engineers, 2 nurses, 2 corporate professionals, combining incomes of $80,000 to $100,000 each. Together they clear that $158,000 threshold and can realistically manage the monthly costs without destroying their financial lives. This is increasingly becoming the only viable path for younger buyers entering the market fresh. Third group, family wealth transfers. The so-called bank of mom and dad. More buyers than ever are receiving financial gifts from parents or grandparents to cover down payments. Studies show that in 2026, nearly 1 in 3 first-time buyers receive some form of family financial assistance. If you don't have access to that generational wealth, and most people don't, You are competing against people who are playing a fundamentally different game than you. Now let's tackle the question that is absolutely everywhere in personal finance conversations right now. Should you even be trying to buy a home in 2026? Or is renting actually the smarter financial move? Because for decades, renting was treated like a dirty word. You were throwing money away. You were building someone else's equity. You were not being serious about your future. That narrative was drilled into an entire generation. And honestly, for a long time, in many markets, it was actually true. But 2026 has flipped this conversation completely on its head. And the math in many cities now tells a very different story. Let's compare directly. Owning that $500,000 home costs you roughly $3,700 per month all in, as we calculated. Now what does renting a comparable home or apartment cost in the same market? In most major U.S. cities, a comparable rental runs between $2,000 to $2,800 per month. That's a monthly difference of $900 to $1,700 every single month in favor of renting. Now the homeowner will say, but I'm building equity. And that's true. But here's what they're not calculating. That $100,000 down payment sitting in a low-cost index fund, earning an average 7% annual return, would generate $7,000 per year in investment growth. Plus, the monthly savings from renting instead of owning, consistently invested, compounds into serious wealth over time. This is called the price-to-rent ratio, and in many markets right now, it is screaming that renting and investing the difference is the mathematically superior strategy. Not forever, not in every city, but right now, in 2026, in expensive markets, the numbers strongly favor renters who are disciplined enough to actually invest that monthly difference rather than just spend it. Now let's talk about something that personal finance channels rarely go deep on. And that is the psychology behind why people make irrational housing decisions even when the math clearly tells them not to. Because here's the truth. Most home buying decisions are not driven by logic. They are driven by emotion, by fear, by social pressure, and by deeply ingrained beliefs that were handed down to us before we were even old enough to question them. Think about the feelings involved in buying a home. The pride of ownership. The feeling of stability, the sense of arrival, like you finally made it. The ability to tell people at a dinner party that yes, you own your home. These are powerful emotional forces. And the entire real estate industry, agents, lenders, developers, advertisers, they all know this. And they use it deliberately. There's a phenomenon psychologists call FOMO, fear of missing out. And in housing, it is absolutely lethal to your finances. You watch your friends buy homes. You see family members getting on the property ladder. You scroll through social media and see beautifully decorated living rooms with captions about finally home. And suddenly, renting feels like failure. Waiting feels like losing. And that emotional pressure pushes people into purchases they simply cannot afford. Then there's what behavioral economists call anchoring bias. A seller lists a home at $520,000. You negotiate down to $490,000 and feel like you won. But you anchored to their number, not to what the home is actually worth or what you can genuinely afford. That $30,000 discount still locks you into a payment that stretches you dangerously thin every single month. Understanding these psychological traps doesn't make you immune to them. But awareness is your first and most powerful defense against making a $500,000 emotional decision dressed up as a financial one. Okay, so we've covered the brutal math, the hidden costs, the salary requirements, the interest rate trap, the psychology, and by now you might be feeling overwhelmed, maybe even a little hopeless. And I completely understand that. But this is the part of the video where we shift gears. Because knowing the problem without a clear action plan is just anxiety with extra steps. So let's talk about what you should actually be doing right now, regardless of where you currently stand financially. Step 1. Know your real number. Not the number the bank approves you for. Your number. Sit down and calculate exactly what you can afford using the 28% rule we discussed. Work backwards from your actual take-home income. Factor in taxes, insurance, maintenance, everything. Write that number down and treat it like a hard ceiling that nothing, no agent, no seller, no emotional impulse, can push you past. Step 2. Aggressively build your financial profile. In this market, preparation is everything. That means working on 3 things simultaneously: your credit score, your savings rate, and your debt-to-income ratio. A credit score above 740 unlocks significantly better interest rates. Even a 0.5% rate improvement on a $400,000 loan saves you over $40,000 across the life of your mortgage. That is not a small number. Step 3. Expand your market vision. The $500,000 median is a national average, but markets vary dramatically. There are cities and regions across America where strong job markets meet significantly lower home prices. Remote work has made geographic flexibility more possible than ever before. If homeownership is genuinely your goal, location flexibility might be the single most powerful financial lever available to you right now in 2026. Now let's zoom out and look at the bigger picture, because understanding where the housing market is heading is just as important as understanding where it stands today. And while nobody has a perfect crystal ball, there are very clear trends and signals that every serious personal finance student needs to understand right now. First, supply is still the core problem. America is facing a housing shortage of somewhere between 3.5 to 5 million homes. This didn't happen overnight. It's the result of over a decade of underbuilding following the 2008 financial crisis. Developers pulled back hard after the crash, construction slowed dramatically, and demand kept growing. That gap between supply and demand is the single biggest reason prices have stayed stubbornly high, and it will not be fixed quickly. Building homes takes years. Changing zoning laws takes political will. This problem is structural and deep. Second, demographic demand is not slowing down. Millennials, the largest generation in American history, are still moving through their peak home buying years. Couple that with Gen Z now entering the housing market for the first time, and you have an enormous wave of demand that isn't going anywhere regardless of interest rates or prices. Third, institutional investors have changed the game permanently. Large investment firms and corporations have spent the last decade buying up single-family homes at scale, turning them into rentals and removing them from the ownership market entirely. This reduces available inventory, pushes prices higher, and puts individual buyers in direct competition with entities that have virtually unlimited capital. It's a fight that is fundamentally unfair, and legislation to address it is moving painfully slowly. Fourth, climate risk is reshaping geography. Insurance companies are pulling out of high-risk states like Florida and California. Premiums in vulnerable areas are skyrocketing. Homes in flood zones and wildfire corridors are quietly becoming financial liabilities, and smart buyers in 2026 are factoring climate risk into their purchase decisions in ways previous generations never had to consider. So here we are, the final verdict. The question this entire video has been building toward: can you actually afford a home in 2026? And should you even be trying? Here is the honest answer. It depends entirely on your personal numbers, your market, your life stage, and your financial foundation. But what I want you to walk away with today is this: homeownership is not the only path to wealth. It never was. It was sold to us as the universal goal, the non-negotiable milestone, the definition of financial success. But the numbers in 2026 tell a more complicated and more liberating story than that. If you have the income, the savings, the stability, and the long-term commitment, and the math genuinely works using the rules we laid out today, then buying can absolutely be a powerful financial decision. Equity building, inflation protection, stability, and long-term appreciation are all very real benefits that should not be dismissed. But if the math doesn't work right now, if you'd be stretching dangerously thin, draining every dollar of savings, and praying nothing goes wrong for the next 30 years, then waiting, Renting strategically, investing the difference, and building your financial foundation is not failure. It is wisdom. It is discipline. And it is exactly what this market moment demands from anyone who takes their financial future seriously. The goal was never to own a home. The goal was always financial freedom. And in 2026, the path to that freedom looks different for different people. Your job is to know your numbers, ignore the noise, block out the social pressure, and make the decision that actually serves your life, not the one that just looks good on social media. If this video gave you clarity, gave you confidence, or gave you even one number you didn't know before, then please hit that like button. Subscribe if you haven't already, and share this with someone who needs to hear it. Because this is the conversation that needs to be happening in every household right now. I'll see you in the next one. Stay smart, stay patient, and always, always let the math lead.